So at some point between January and April, it's everyone's favorite season, tax filing season. And even though it's a routine process, it can kind of fill you with a little bit of dread. And that can be in part because you're not sure you're getting a refund or you might owe the government some money. Getting a handle on some basic tax terminology can help you to feel a little bit better about filing that return. And as a bonus, it might even save you some money. Today, we'll talk about two of the most common ways of lowering your tax bill: tax deductions and tax credits. So before we get into all the fun details about taxes, I just want to make it clear that I am not a financial advisor and that this is not personalized tax advice. Anyway, let's get on to tax deductions. The way that tax deductions work is that they essentially lower your taxable income, which is a fancy way of saying that they lower how much of your income is subject to taxation. Let's walk through an example. Let's say that your income for the year is $60,000 and the tax rate you're subject to is 25%. In order to figure out how much you're going to owe in taxes, you're going to want to multiply your income by that tax rate. In this case, that would leave us with $15,000 owed in taxes. Now, let's revisit that same example, but this time let's apply a $10,000 tax deduction. In this case, you'd want to subtract that deduction from your income of $60,000, and that'll leave you with an adjusted income of $50,000. You'll then multiply that by the tax rate of 25%, which will leave you with a total tax bill of $12,500. As you can probably tell, applying that deduction saved you quite a bit of money, a grand total of $2,500. All of this makes deductions sound great, and they are, but there's also a lot of rules that govern how they work. For example, in the US, there are two ways that you can take deductions. You can opt for what's called the standard deduction, or you can choose to itemize. But the catch is, you can't do both. When you take advantage of that first option, the standard deduction, you're basically taking a flat, no questions asked fee and subtracting it from your income in order to lower how much is taxable. That fee is determined by the government each year based on inflation, and how much you get will be dependent on your filing status. According to the IRS, it's also immensely popular. 9 out of 10 taxpayers take the standard deduction over itemizing. For the 2021 tax year, the standard deduction is $12,550 for those who are filing single or married filing separately, $25,100 for those who are married filing jointly, and $18,800 for heads of household. If you're over 65 or visually impaired, you generally get a slightly higher standard deduction, about $1,000 or more. So the other option that you have when it comes to taking deductions is to itemize. And when you itemize, you're basically tallying up each individual tax deductible expense that you have one by one. Now, that can sound like a lot of work, and that's because it is. It can mean having documents, receipts, paperwork in order to substantiate that you're eligible to qualify for those deductions. But it could also be well worth the effort. If you think that your individual deductions will add up to more than your standard deduction, it could save you some money in the long run. If you've spent a lot of money on one of these things in the past tax year, such as state and local taxes, sometimes called the SALT deduction, interest paid on your mortgage, certain unreimbursed medical expenses, it might be worth doing the math and some extra research to see if you get more out of itemizing versus taking the standard deduction. And that's because you can only really take advantage of these tax breaks if you itemize. If you still have some doubts about whether you should take the standard deduction or whether you should itemize, you can work with quality tax software or a tax professional, or you can run the numbers both ways. That way you can see which option ends up saving you more money. Tax credits, on the other hand, work a little bit differently than tax deductions. They give you a reduction in your tax liability, which is basically just a reduction to your tax bill. And how that works is that the credit gets applied directly to the taxes that you owe, meaning you can subtract the credit from your taxes. So let's say that you have a $2,000 tax bill, but you're also eligible for a $1,000 tax credit. You can subtract that $1,000 credit directly from your taxes owed, which will lower your total tax bill to $1,000. So it's clear that tax credits can have a major impact on your tax bill. But there's also another layer to them. They can be what's called non-refundable or refundable. When a tax credit is non-refundable, that basically means that it has the potential to lower your tax bill to zero, but it won't result in a refund. Some examples of non-refundable credits include credits for education, such as the Lifetime Learning Credit for qualified tuition and fees, credits for retirement, such as the Savers Credit for qualified retirement contributions made by low to middle income taxpayers, and credits for green purchases, such as the Plug-in Electric Vehicle Credit for the purchase of a qualifying electric vehicle. Let's say that you qualify for a $3,000 tax credit this year, and you also have a $2,000 tax bill. If that credit is non-refundable, your tax bill will simply be erased, and you won't owe anything since the value of the credit exceeds your bill. On the other hand, let's take that example and apply a refundable tax credit this time. On a $2,000 tax bill, a $3,000 tax credit will not only erase your total taxes owed, but you'll also get a nice $1,000 check from the IRS. So refundable tax credits can be pretty advantageous for the taxpayer, which is why the IRS doesn't dole them out very easily. Some examples of refundable tax credits include credits for parents, such as the child tax credit, credits for low to middle income earners, such as the earned income tax credit, and credits for education, such as the American Opportunity Credit. That one's partially refundable. So just as with tax deductions, taking advantage of certain tax credits requires you to meet certain criteria. That could be a certain income, it could be a certain filing status, it could even be a certain life circumstance. So as with anything tax related, you want to make sure that you read the fine print. Now that we understand that a tax deduction will reduce your taxable income and a tax credit will reduce your tax liability, let's take a look at what that means using a side-by-side comparison. Let's say that your adjusted gross income is $100,000 and you're eligible for a $10,000 tax deduction. That'll lower your taxable income to $90,000. That $90,000 then gets taxed at the percentage of your highest tax bracket. For this example, we're going to assume it's a flat 25. The total tax bill will then get calculated by multiplying that tax rate, 25%, by your now reduced income of $90,000. For a grand total of $22,500 owed. Now, let's look at the same situation, but apply a tax credit. On a $100,000 income taxed at 25%, the total tax bill would be $25,000. But then you get to apply the $10,000 tax credit to the total bill. That'll slash your taxes owed to $15,000. So as you can tell, the tax deduction and the tax credit both had an impact on your tax bill, but the tax credit had a far greater one. The good news is that you don't have to choose one or the other. If you qualify for some tax credits on top of your tax deduction, you can generally take those as well. If you want to learn more about taxes, make sure to check out our website. We cover everything from capital gains taxes to cryptocurrency taxes and even how to fill out your W-4. At the end of the day, both tax credits and tax deductions have the ability to lower your bill. And the key in deciding which ones work for you is really just a matter of research. Or you can work with a quality tax software or a tax professional to decide which route works best for you. I'm Sabrina Parys, and I'm a taxes writer at NerdWallet. Fun fact, for the first time in I don't even know how long, I actually filed my taxes before March. If you feel like you learned something, make sure to hit that like button and subscribe.